Hey, what's going on guys? This is Kedar here. So today in this video, we have got a really important question on the Fed interest rates and how do these hikes slow down the inflation. How does rising rates stop the inflation after all? How does increasing Fed rates will decrease down the inflation? There is a very important effect that you should understand how increasing Fed rates will control the inflation down. Right now, pretty much all the Americans are facing with higher food and gas prices. That's why rising interest rates are very important to combat this inflation. So when will the Fed announce the next interest rate hike and how many times Fed has raised the interest rates in the 2022 and how much will the Fed raise are expected to rise again? Are interest rate hikes good for the stocks? How does this Fed hike work? How does it impacts the prime rate and 10-year treasury bond? And how the Fed interest rate hike will bring down the inflation? We have got all the details in this video. So before we get into all those details, make sure to check out other videos from our channel and do subscribe to our channel with bell notification turned on. That will keep you up to date on latest stimulus update. And with that being said, let's get right into the video. So the Federal Reserve has been rising the interest rates as it races to tamp down the rapid inflation. And due to these moves, a lot of people have been already wondering why the rates are increasing right now. And inflation right now is being driven by economic mismatch. Therefore, consumer demand for goods and services have been chugging along and supply has been not keeping up. And that's because the transportation is slowing down. Also, factory shutdowns combined with the labor shortages to slow down overall production. And this same clash has allowed the companies to charge more for their products they already sell. And we all know that Fed's tools are blunt. And they can work only on one side of the equation, that is the demand. And central bankers cannot fix the ruined supply chains, but their higher interest rates can slow down the economy enough so that the businesses and households feel the pinch, which should in theory translate into slower wages growth and less spending and lower prices. And that process is obviously painful one, and so why is the Fed is doing this interest rate hikes. But when it comes to the controlling this inflation, time is essence. And if these price increases run fast for a month or a year or even more than that, then people could start to adjust their lives accordingly. Therefore, workers might ask for higher wages to cover their climbing expenses, which ultimately pushing up those labor costs and prompting businesses to charge even more. And slowly companies might start believing that consumer will accept the higher prices, making them less vigilant about avoiding all this. So pretty much all the Americans are struggling with higher food, gas and rent costs right now. And according to the figures, while the annual inflation has slowed down in the August, it already remained at those higher levels. In August, it was like 8.3%, which was near a 40-year record high. On the Wednesday, Federal Reserve already raised the interest rate by 0.75% point to bump the federal funds target range right from the 3% range to 3.25%, and this is all in effort to bog down the inflation. This was the third consecutive time Fed has raised the rates by that amount. The first time this was done in the June. At that time, this was the largest increase at a single meeting since 1994. So after all, why these Fed hikes used to combat the inflation? How do they actually work? So let's check out all these things in detail. Now when it comes to Fed announcement, when they will announce the next interest rate hike, Fed is expected to announce more rate increases this year. And according to FOMC, the body within the Fed, they decide the monetary policy including the interest rate hikes. Also, more committee meetings are scheduled for November and December. And the Fed's economic projections released on Wednesday showed that median Fed funds rate at 4.4% by the year end will go up by 4.6% next year. So let's check out how does this Fed hike work, how does it impacts the prime rate and 10-year treasury bond. Now as the country's central bank, the Federal Reserve in charge of the monetary policy, its dual mandate is to promote maximum employment and stable prices in the US economy. And stable prices mean keeping the inflation in check with a long-term mean annual target of 2%. In the year 2020, the CPI inflation was just about 1.4%, and in 2021 it already shooted up to 7%. And one of the Fed's main tool is to impact the inflation is the federal funds rate. Speaking of the federal funds rate, now this is the rate banks charge each other for overnight loans. And although the Fed doesn't directly control all those interest rates, when it raises the federal funds rate, most of the other interest rates eventually follow the suit. And this including adjustable rate mortgages, also the credit cards and home equity lines of credit and other loans. Now some of these rates are tied to the prime rate, which is based on the federal funds rate. And a rising federal fund rate also impacts the 10-year treasury bond, which ultimately impacts the mortgages, and therefore borrowing money then becomes more expensive for consumers. Therefore, consumer in turn spend less and demands begin to wane and the inflation, in theory, inflation starts to relent. Meanwhile, some Americans, particularly senior citizens, will see higher bank saving rates, so that's a bonus point for them. Speaking of how many times has the Fed Reserve has raised the Fed interest rates in 2022? Well, Fed has raised the interest rate 5 consecutive times this year, and the pandemic shutdown of the economy had kept the rates to near zero before the Fed increased the rates by 0.25% point in the March, but this one is the first hike in the more than 3 years. An additional increase of 0.50% point came in the May, followed by 0.75 percentage point bump in the June and another 0.75% in the July, and the latest 3 quarters of the point on the Wednesday, putting the rate at its current range of 3% to 3.25%. So how much will the Fed will increase the rates? Well, as for the economist surveyed by Bloomberg, they predict an upper end of the range would be reaching as high as 4% by the end of this year. But those are the estimates and that are likely to ratchet higher now after the Fed's median economic projections show that the Fed funds rate reaching to 4.4% by the year end and about 4.6% in the upcoming year. Now speaking of the interest rate hikes, are interest rate hikes good for the stocks? Well, interest rate hikes create volatility in the stock market. The value of the future earnings tend to dip down when the higher interest rates are expected, according to the US Bank. And this makes all the investors less eager to bid up onto the stock prices. That's why these interest rate hikes are not good for the stocks. Higher interest rates meaning that economy is slowing down, which can stunt the revenues for the companies, which is potentially damaging for their growth, also for the stock prices. And by making money more expensive to borrow, Fed's rate moves work relatively to quickly temper down these demands, and as buying a house or buying a car or expanding a business becomes a pricier job, therefore people will pull back from doing all those things, and therefore with pure consumers and companies competing for available supply for goods and services, the price gains are able to moderate. But there is a risk involved in that, and that is the Fed's process could come at a hefty cost given today's dynamics. The supply of the goods looks like while it is improving somewhat, it remains to be constrained as of right now, and cars are still hard to find because of the semiconductor shortages. Also, furniture remains on back order, and jobs are more plentiful than the laborers, which is ultimately bringing the economy back into the balance. Therefore, it could require a big decline in demand and slowing down the economy that meaningfully could tip off a recession while leaving those workers unemployed and families with lower incomes. Jeremy H. Powell, the Fed chairman, acknowledged that the path ahead could be fraught. While higher interest rates, slower growth, and softer labor market conditions will bring down inflation, one thing to note is that they will also bring down some of the pain to households and also for the businesses. So now you know why does the Fed raise the interest rates and how do those hikes will slow down the inflation. This is all based on the supply and demand chain. To bring the US economy back on track, it is absolutely necessary to increase the Fed rates. Therefore, slower growth may be expected, softer labor market conditions, but this will ultimately bring down the inflation. We all know that this will bring some pain to households and businesses, but this is absolutely necessary because failure to restore the price stability would mean far greater pain in the end. So what do you think about this? Do let me know in the comments down below, and make sure to subscribe to our channel with bell notification turn on. That will keep you up to date on latest stimulus update. Do check out other videos from our channel, and this is Kedar from How to Guys signing out.